Great news, everyone. Crypto winter is over. We are so back.
Crypto winter? Brody, wasn't that like 2 years ago?
I wasn't talking to you, Giga Chad. I was talking to my VCs here. Look, crypto winter might be long gone for you and I, but venture capitalists, the people bankrolling this whole industry, well, they didn't get the memo. VC investment in crypto has been falling for almost 2 years straight. Well, until now, that is. The latest numbers are in, and it looks like the VCs are finally flashing their cash again.
So, like, how much? How much can I copy trade?
Bro, patience. I'm going to explain how much VC money is coming in, where it's going, and what it means for us this cycle. So, just try not to get liquidated while I'm talking. Okay, let's recap. Venture capital investment in crypto has historically followed the price action of BTC with a lag of about 1 quarter. So, when we saw VCs invest a record $12 billion in the first quarter of 2022, this was likely their reaction to the euphoria of the 2021 bull run. Now, as we all know, 2021 was the year when BTC raced up from sub 30k to a new all-time high of over 69k in Q4. The VCs were excited. We were excited. Your taxi driver was excited. You know, cycle top vibes. It was a good time. But as usual, just when the markets look like they're never going to stop going up, well, you know what happens next. Cue a black swan or two coming along to spoil the party. Well, in 2022, it was more like a flock of black swans flapping about all over our portfolios. 3AC, Terra Luna, Celsius, Alameda, FTX, BlockFi, 15k BTC. In other words, a world of pain. Now, it's hard to overstate just how bad that year was for crypto. A lot of people lost a lot of money, and crypto's reputation was battered by its association with hooligans like Sam Bankman-Fried. Needless to say, crypto VCs got wrecked as well. If not financially, then perhaps reputationally and definitely emotionally. Ever since that frothy peak in Q1 2022, VC investment in crypto has been drying up. Large generalist VCs who dipped their toes into crypto decided to shake the scene, while crypto-specific VCs basically went into a coma. Investment continued to fall for 7 straight quarters, which is remarkable because it's much longer than the downtrend in the crypto market itself. Now, I don't know about you, but when I hear the words crypto winter, I specifically think of 2022. BTC dumped the entire year and finally bottomed in Q4 around 15k. It was freezing. Now, 2023, on the other hand, was a different story. BTC started the year around 16.5k and finished it around 44k. That's a 160% rally. Doesn't look very wintry to me. And yet, VC investment continued to fall throughout the year and only found a bottom in Q4, somewhere below $2 billion. Ironically, this was the quarter when BTC hit escape velocity in anticipation of the spot ETF launches in the US. It took BTC rallying 60% in the last 3 months of 2023, but crypto VCs have finally snapped out of their coma and started writing checks again.
Hold up a second there, Guy. Sorry to interrupt, folks, but I just wanted to very quickly tell you about the Coin Bureau deals page. Now, this is the place where we have put together some of the very best deals and promos in all of crypto. So you can think things like exchange sign-up bonuses, trading fee discounts, and money off of hardware wallets, and much, much more besides. So if you want to check that out, coinbureau.com/deals is the place to go, or you can just use the link in the description of this video down below. Thanks very much, and now back to you, Guy.
So, I'm delighted to report that in the first 3 months of 2024, the number of crypto VC deals increased by about 45%, and the amount of capital invested was up by more than 40% quarter on quarter. This marked the first quarterly increase since the start of 2022. Hallelujah! However, we might not be out of the woods just yet. That's because, despite the large uptick in percentage terms, VC investment is still at historically low levels. In Q1 2024, we clawed our way back up to $2.4 billion, but that's still 80% down from where we were in Q1 of 2022. The number of deals taking place is likewise a fraction of what it was back then. Now, this has us wondering. BTC made a new all-time high in Q1, and VC investment data tends to lag BTC's price action by 1 quarter. So, now that Q2 is over, are we not due a massive influx of investment from VCs playing catch-up? Or is the correlation between BTC's price and VC investment now a thing of the past? Well, at the time of making this video, Q2 2024 has just drawn to a close, so we don't have all of the data just yet. However, the numbers that are available so far aren't exactly swashbuckling. Just look at this chart from Bloomberg. It was published in mid-June, 2 weeks before the end of Q2. It shows VC investment in crypto year-to-date standing at $4.2 billion. And remember how $2.4 billion of that figure came from Q1. So, either there are some juicy investment deals missing from Bloomberg's data, or we're in for another disappointment. Because if this chart is to be believed, VCs have invested less than $2 billion in crypto this quarter, and that, my friends, is not much to write home about. Now, we'll refrain from drawing conclusions until all of the data from Q2 is available. But at the moment, you might be wondering why VC investment hasn't caught up with the massive BTC rally we saw in Q1. And for that matter, what will it take for institutions to really turn the taps back on? Well, a good place to start looking for answers is in the macroeconomic context. This is because the ability and appetite of institutions to make risky investments is more or less decided by macroeconomic factors, like interest rates, for example. The impact of macro trends, rather than crypto-specific ones, becomes clear when you compare investment in crypto to another adjacent sector, say, fintech. You can see from this chart, for example, that crypto doesn't exist in a bubble. Just look at 2021. We thought that was a crazy year for crypto, but it was even crazier for fintech, which raked in $113 billion in investment globally. That's more investment in 1 year than crypto has seen in the last decade. And if hearing that makes your stomach ache, then I've got 2 words for you. Still early. Anyway, after peaking in 2021, investment in fintech fell by 65% over the next 2 years. Sure, that's not quite as down bad as crypto investment, which fell by around 80% in the same period, but it's a prolonged and severe downtrend nonetheless. In other words, it's not just us. We're all riding the same macroeconomic wave, so we probably shouldn't feel too bad about crypto. 2022 may have brought the industry almost to its knees, but it seems to be macro factors, namely high interest rates, that have kept it there. But one day, the Federal Reserve will lower interest rates, liquidity conditions will improve, and institutional investors will be desperate to FOMO into risk assets once again. Or so goes the bull case, at least. And hey, if you're looking forward to that juicy rate cut announcement, then obliterate that like button, and if you're enjoying the video, then go ahead and subscribe to the channel and ping that notification bell so you can be the first to see our next one.
We're actually seeing the beginning of really good results in Q1. And after a 2022, which were a complete mess, especially firms that had budgeted at the end of 21 for a strong 22 and massively, disappointed.
Now, while we're on the topic of funding levels, it's worth asking just how much VC investment is desirable or appropriate. Because believe it or not, too many VCs throwing too much money around can actually cause problems. And arguably, the last bull market took us well into overfunded territory. The example par excellence is the NFT spending spree led by crypto VC juggernaut Andreessen Horowitz, aka A16Z. In spring 2022, A16Z raised $4.5 billion for its 4th crypto VC fund and led a $450 million funding round for Bored Apes NFT developer Yuga Labs that valued the company at $4 billion. The outlandish sums associated with Yuga Labs created a bubble of similarly outlandish expectations, and we all know how that ended. Since A16Z's investment, the floor price of Bored Ape NFTs has pulled a minus 10x. The CEO of Yuga Labs jumped ship, and his replacement told staff earlier this year that the company has, quote, lost its way in an email announcing layoffs. Now, we could go on about Yuga Labs, but no need to flog a dead horse. Bored Apes were just the frothiest of froth from the last bull market, but they aren't the only symptom of overfunding. And here is a scorching hot take for you. Despite VC investment being down 80% from its high in 2022, we may be seeing signs of overfunding in this cycle already, or at least saturation in the VC fundraising scene. But don't take it from me, just listen to what crypto VCs are saying. Recently, TechCrunch interviewed 9 crypto VCs for an article about the state of crypto fundraising in 2024. Altogether, they describe an upside-down landscape where some funding rounds are so oversubscribed that it's the investors rather than the project founders who have to pitch their own value. According to another 2 of the VCs interviewed, quote, "It is common to see rounds get oversubscribed within days of coming to market, and, quote, filling out before investors have time for intensive due diligence." As another VC put it, quote, "Raises that would have taken months or not happened at all last year, even for high-quality teams, are now happening in weeks or less with better terms for founders." According to another, meanwhile, the fierce competition has meant that, quote, "Valuations are up significantly, and even when larger, more established firms pass on a deal, founders still have plenty of options with others. Some of the valuations we're seeing are already a bit outlandish, given how early we are in this cycle." He's not kidding. According to a recent report published by Galaxy, quote, "Deal sizes are flat quarter on quarter, but valuations are up almost 100%. But as yet another VC told TechCrunch, investors gladly, quote, "accept lofty valuations in private rounds since they expect that the tokens will be traded publicly at a significant markup." Now, don't get me wrong, I love to see crypto founders and developers being able to secure funding on fair terms without having to beg for it. But after a certain point, a packed crowd of hungry VCs competing to throw money at projects before they've even made it through the white paper is going to cause problems down the line. I'm reminded of a comment made by Haseeb Qureshi, managing partner at Dragonfly Capital and one of the most vocal crypto VCs on the scene today. On a recent podcast episode, he said,
"If you look at the previous cycle, one of the criticisms that many people levied against crypto influencers and against VCs as well was that there was a lot of bullshit that everybody knew was bullshit. And most people didn't say anything. And I think on some level, that was one of the lessons that I really took away from 2022.
And Haseeb wasn't the only one who took a dim view of some of the VC deals from last cycle. Another VC quoted in the TechCrunch article recalled, quote, "Deals in 2021 felt like you had a gun to the back of your head. That feeling has kind of returned to the market a bit." Yikes. Now, the implications of such a fundraising environment are far-reaching. From VCs rushing to cut checks for snake oil salespeople and vaporware founders, to new cryptos launching at absurdly high valuations, overfunding and saturation in the VC market are not necessarily a net positive for crypto. And if you need any more convincing, you should check out our video breaking down the low-float, high FDV phenomenon. You'll learn how oversaturated VC funding rounds and the so-called phantom market have been squeezing every last drop of value out of new cryptos before they've even launched. It's a fascinating rabbit hole, so do give it a watch. Anyway, all of this is just to say that if VC money flowing into crypto doesn't break a new all-time high anytime soon, it might not be the end of the world. Take Paradigm, for example. They're one of the leading crypto VCs. When Paradigm announced its new $850 million fund for early-stage crypto projects this year, observers were quick to note that this is less than a third of the size of Paradigm's last fund from the previous cycle, which was $2.5 billion. But if you ask us, $850 million isn't exactly chump change. We've seen what those multi-billion-dollar funds gave us, and frankly, it was a lot of monkey picks and giga-high FDV coins. So we should have a good think before hoping to run that one back again. Okay, so there's the big picture. Crypto VCs are finally showing signs of life again. The deals aren't as eye-watering as they used to be, but maybe that isn't the worst thing. So that leaves us with only one question. Just what exactly are the VCs betting on now? Well, for an answer, we can turn to this chart shared by Galaxy. It breaks down projects into 19 categories and shows that just 4 of them sucked up around 70% of all the capital invested in Q1. But before you start taking notes, it's worth asking how these categories are composed, because some are much broader than others. For example, the wallet category is very straightforward. You're either a wallet project or you're not. Now, wallets raised 1% of the money spent by VCs in Q1. That is nice and easy to understand. By contrast, however, the infrastructure category, which took home 24% of the total capital Q1, is rather more open to interpretation. In Galaxy's formulation, infrastructure means staking, restaking, platform tools, sequencing services, or other tooling for blockchain developers and users. And, notably, infrastructure here excludes actual blockchains, including Layer 1s and Layer 2 scaling and interoperability solutions, which, by the way, failed to draw in even 10% of VC investment in Q1 between them. So I guess everyone agrees we have enough chains by now. Anyway, infrastructure's share of the pie is carried to a significant extent by the blockbuster deals closed for EigenLayer, the Ethereum restaking protocol, and Zama, a fully homomorphic encryption development platform. These were two of the biggest deals closed in Q1. EigenLayer's Series B funding round was led by A16Z and raised $100 million in February. In March, Multicoin Capital and Protocol Labs led Zama's Series A round, which closed at $73 million. And there was a larger deal mentioned in another report on crypto VC activity in Q1, shared by PitchBook. Notably, it was absent from Galaxy's report. It's a generative AI startup called Together AI that raised $106 million in an early stage round led by Salesforce. And if that doesn't sound very crypto to you, well, we'd have to agree. PitchBook describes Together AI as, quote, the developer of an open source, decentralized cloud platform for large foundation models. As such, they explicitly categorize it as a DeepIn project. However, we can't find any crypto or blockchain component to what they're doing, so perhaps we should side with Galaxy and leave this one to Silicon Valley. Anyhow, turning back to Galaxy's chart, you'll see that projects grouped in the sprawling Web3, NFT, DAO, metaverse gaming category collectively claimed 21% of VC money in Q1, the second largest share. Now, I have to say, if you're going to make a chart with this many categories to start with, then I'm not sure why these 5 segments should be condensed into just one, but well, maybe that's just me. At any rate, Galaxy says that this segment is mostly carried by gaming deals, which saw an uptick in Q1. Now, the third largest category covers trading, exchanges, investing, and lending. Kinda sounds like centralized exchanges to me. They took in 17% of the funding in Q1. Now, this is a pretty evergreen segment and a straightforward category, so this isn't especially remarkable. What is remarkable, though, is just how little investment went to some of the narratives considered to be the hottest in the crypto market proper. Take AI cryptos, for example. In Q1, they ran hard, but AI crypto startups, on the other hand, attracted just 2% of the capital invested by VCs. Now, Galaxy's chart doesn't have a category named real-world assets, but there is one for tokenization. I'm going to go out on a limb here and say that these terms are more or less synonymous. So, RWA cryptos attracted a lot of interest in Q1, but Galaxy's tokenization segment took in just 1% of VC investment. Similarly, Galaxy has no category for DeepIn, which was another one of the hottest buzzwords in crypto this year so far. Now, presumably, DeepIn projects didn't receive zero investment in Q1, so it's rather left to our imagination as to which category, or categories, they belong to here. Okay, now that's enough of that chart. Here, though, is another one, this time showing capital invested by stage. The stages included are pre-seed, seed round, early stage, and later stage. Now, if you're not familiar with the nomenclature, here are what these mean. Pre-seed investments will be the first investment received by a founder or co-founders who have an idea for a startup. They have no revenue at this stage and are likely spending their own money or funding from friends and family. Startups can move to a seed round when they have a minimum viable product, basically something they can sell to someone. Early stage startups will have some kind of product market fit and are clearly solving some kind of problem, but their go-to-market, growth and business model strategies are less certain. Later stage will mean a company that has overcome these hurdles and is now looking to upscale its operations. Now, in Q1 2024, VCs leaned heavily into early stage projects, which accounted for the lion's share of deals closed and capital invested. This bodes well for founders with fresh new ideas and a minimum viable product to sell, as VCs will compete to hand them more money with more favourable conditions. Now, pre-seed and seed rounds were decently represented across most market segments. These tend to involve smaller amounts of capital, so looking at the number of deals closed rather than the amount invested is more instructive here. If there was a loser in the Q1 fundraising scene, it would have to be the well-established crypto projects aiming to upscale operations. Later stage fundraising rounds tend to involve the largest sums of money, but you wouldn't know it from this chart of VC capital invested by category and stage. A few categories like payments/rewards, privacy/security, banking, AI, and enterprise blockchain saw a large proportion of capital invested going to later stage rounds. But on the whole, this was not the case. Galaxy explains that the exit of large generalist VC firms from crypto since 2022 might be to blame for this. To illustrate this point further, we can return to PitchBook's report. This showed that the median pre-money valuation for projects in early-stage fundraising rounds in Q1 was $72 million, up almost 150% year-on-year. For projects in late-stage rounds, the median was $51 million, up just 7.6% year-on-year. Does it make sense for well-established projects to be valued so much lower than early-stage ones? Perhaps not, but the later the stage is, the harder it will be to persuade anyone that you are the next unicorn. Suffice to say, the hopium is flowing freely in those early stage rounds, so let's hope that the best new ideas win and a real crypto unicorn emerges this year. So then, if you want to bid like a VC, then should you ditch AI, RWA and DePIN for well-funded infrastructure projects in GameFi? Well, it's hard to say, particularly as infrastructure includes a lot of tools and sequencing services that may not plan to release a token. If one thing is for certain though, there's no shortage of well-funded, brand new projects in the pipeline, and no doubt many of them will launch their own coins and tokens. The current market is extremely saturated and liquidity is highly fragmented as it is. This means that as the cycle progresses and more cryptos are launched, you're going to have to work harder and take doing your own research even more seriously. That is, until the levees break and marginal buyers come flooding back in to pump our bags wantonly. I mean, they are coming, aren't they? You know what? Let's leave that for another video. Alright, that's enough VC wheeling and dealing for one day. If you learned something new in this video, be sure to have a strong word with the like button so more people can see it. And drop us a comment if you think we missed any important VC developments, and don't forget to subscribe and ping the notification bell too. That's it for today, folks. Thank you for watching, and I'll see you again soon. This is Guy, signing off.